So first of all, I'd like to thank everybody for joining us this morning at our audience with Muse and FundOnion. I'm going to do a quick intro to both companies and then we're going to get straight into it. So Muse, if you don't know who Muse are, they are a rising fintech disrupting the traditional alternative finance market. They have an app-based finance solution to UK businesses, and users can seamlessly integrate their business accounting packages and banking details to receive a 30 to 90-day financial forecast. This tool helps to assist identify shortfalls in payments and in turn provides access to flexible funds through Invoice Finance in as little as 24 hours. They help small and medium businesses prosper in unprecedented times, and they are redesigning financial services specifically for the SMEs and their unique needs. And Peter, who is going to be speaking for Muse. So Peter is one of the sales directors. He's got over 30 years experience in receivables and working capital. He's a skilled financial professional and successfully helping businesses unlock money from their balance sheets. He is passionate about delivering timely solutions that not only foster strong relationships, but also significant growth for both his clients and partners alike. So we'll be hearing more from Peter in a minute, but FundOnion. So FundOnion are the brokers on the panel, and they are an online matching platform that helps small businesses in the UK small businesses in the UK access lenders in less than 90 seconds, and it's all for free. So they are the only business finance platform in the UK that shows lender names, rates, fees, and includes short profiles of each funders prepared by their own expert in-house team. They blend tech and a personal approach, and their FundOnion brokerage team have experience of a whole market of commercial finance brokers to assist businesses directly as needed. They've got over 50 million in funding applications done this year alone, and they're endorsed from the British Pest Control Association, the British Entrepreneurship Awards, and 5-star Trustpilot reviews. So they are looking to change the way businesses access finance, prioritising transparency and ease of use for firms looking to raise anything from 10,000 to 5 million. So FundOnion, if you'd like to start, and the point of this audience with is to help people to get to grips with their business cash flow. So how would you help businesses to get to grips with their business cash flow?
Well, I think, Samantha, thanks for the lovely introduction, and great to be here with Greg's Choice and obviously Muse as well, and Peter. Great partners in the SME space that we know.
Absolutely.
I guess in response to your question, cash flow, it's a often said but a bit of a trite saying, but cash flow is king. Mm-hmm. We can see so many businesses out there that actually on their year-to-date financials, they might be strong, they might be profitable, but at the end of the day, businesses don't live in an individual vacuum on their own. They're constantly dealing with other stakeholders, be that employees, be it HMRC, be it other suppliers, be it other people they're working with. And ultimately, if you run into a cash flow situation where you simply say, I can't pay right now, I'm waiting for invoices to be paid. You might see a situation with a retailer or a small startup e-commerce company. They might say, I'm waiting 30, 60, 90 days to get paid by my blue chip client that is so credit worthy. But if they run into that issue, then they start to go, they can, in the best case scenario, they can negotiate terms with their creditors and look to reach an amicable situation. But at the same time, it's quite stressful on a personal level. And ultimately, in a worst case scenario, you can end up having, liquidation or bad debt proceedings being brought against the company. So it's one of those things you have to constantly manage. Yeah. And I think sometimes people might just think about the top line, the bottom line profitability of the company. But at the end of the day, keeping your cash flow in check is a really important thing. And there are some great solutions out there, including Muse as well, to help companies manage that issue.
That's a lovely transition.
Thank you very much.
Yeah, I'm going to say thank you very much for that. That was done so seamlessly. Thank you, Sam, for the warm introduction. And James, I totally agree with what you say. I have been in this industry since 1985, and I think the commonality that I see is that businesses don't understand the difference between cash and profit. So you may have a balance sheet that shows good retained level of earnings. You may on paper be showing that you've made profit, very much like an old person sitting in a £1 million house, no mortgage, but not enough money to buy a pint of milk. They've got no cash. And I think the scenario is that businesses don't understand that they burn cash every single day. And that is what kills a business. And I've seen so many good businesses fail because they have not identified the need for cash and how to get cash. And often that is because they fall into a business, it becomes successful, it grows out of control, and they allow their customers to control their business. And fundamentally, a lot of businesses don't understand their own credit terms. For example, the business, they may say that they've got a 30-day credit term. But what exactly does that mean? Is it 30 days from date of invoice? Or does your customer believe it's 30 days from the end of the month? Because they're two different things. And of course, as you rightly stated, there are many solutions to how you're going to fund your business, but which one suits you all depends on your business being understood by you, your credit terms being understood by you. If your business is growing rapidly, then you need a working capital facility that is going to grow in line with your turnover, your sales, your customer growth. That ain't the bank, because the way in which a bank facility works, it's retrospective in the sense that what security have you got to be able to facilitate a facility, quote unquote, that's going to fund you for the next 12 to 18 months? Well, it's not. And where we come in as a funder, we understand that. So we get to understand the business from the point of view of its credit terms, its customer payments, the debtor profile. So we can make a decision as to whether or not this business is one we can support going forward. And we do that through a number of different services and products. I think, as Sam alluded to, our check embeds with the client. It works out from the AI, the predictability of cash based on payments going out. So it gives a cash flow, give you a view of your business in the next 30 days. What cash are you going to need in the next 30 days? These are the invoices you have available that you can sell to Muse to fund that particular requirement. It does the same over 60 and 90 days. And I think as the economy is quite turbulent at the moment and about to become more turbulent, I think with companies like the Director's Choice and like FundOnion, businesses need to listen to what you guys are saying, because you understand exactly what's going on, you know exactly where to go, and you can signpost them to the right company. It may not necessarily be Muse, but you'll signpost them to a company that's going to fit their requirement. And if that requirement is working capital, it's going to come to Muse. But the most important thing is to get companies to understand the difference between cash and profit. They are not the same thing.
Absolutely.
Can I ask a question? So, I mean, for those people out there who are watching this, it might be the first time they've ever heard the words invoice finance. Can one of you or both of you explain in layman's terms what invoice finance is and how it will work for a business and how that's going to release some cash flow?
I think it's better be me as got invoice finance on my business card. Well, invoice finance. Invoice finance is a very, very simple product. It's a product that's not widely understood. And I would say 90% of my day job is educating key business influencers, these are introducers, and then educating the clients that they submit. So an invoice finance company effectively buys the waiting time attached to an invoice. That's the simplest way to look at it. Mm-hmm. So you are a customer and you've just made a sale of, let's just pick my favorite wine, Villa Maria. You've just sold 1 million cases to Waitrose. Now, with all the will in the world, Waitrose is not going to pay you on the nail. Your supplier may want payment bang on 30 days. Doesn't care where you get the money from, wants payment on 30 days. Waitrose will pay you in 60 to 90 days. So there's an imbalance. You've got an undoubted debtor, probably the best business within the John Lewis partnership, sitting there. So it's not a question of can't pay, won't pay to your terms. Mm-hmm. Within that time frame, you've got staff wages. You can't go to your staff and say, I'll pay you when Waitrose pay. Just not picking the Waitrose. There are other multiple retailers out there as well, all sell perfectly good wines. Mm-hmm. You've got your HMRC payments to make. You've also got your rent, gas, light, vehicles. All of that stuff has to be paid for, working capital. So your overdraft will not necessarily cover that particularly if you do more than one or two of those trades. So what the invoice finance company will do is buy the time, which is the 90 days. By us purchasing the invoice from you immediately, it's raised. And that's got to be by way of proving to us the goods have gone, normally a delivery note. We'll make payments up to 90% of the invoice value to the supplier that day. So the supplier becomes cash rich. So if the invoice is £1 million, we will inject up to £900,000 on day one. Just an easy number. The supplier can pay his supplier, meet their day-to-day obligations, and trade through. Now, if the supplier then goes into a bank and presents that invoice to say, here it is, Mr. Bank, I've got £1 million owed to me by Waitrose. To the bank, it's a piece of paper. The bank wants to say, well, hang on, what are you worth? Do you have £1 million in your house? Because if this does not get paid, I want to be paid. I want to be paid by your private assets. Unfortunately, most SMEs are undercapitalized. They don't have any money. They just have the ability to link a supplier to their customer and stand in the middle, effectively, is what they do. So what Muse allows that business to do is to generate cash flow by selling the invoices to us on a regular basis. And that is what invoice finance is. We buy time. If another invoice finance company don't say that, they don't understand it. We buy time. We take the weight. And attached to that are services such as we are better than most SMEs at collecting debt. So we've got a whole plethora of individuals who will collect the debt from your customer, will reconcile that for you, will allocate it, and up to and including legal action as well. So we give a small SME the same firepower as a large entity. Now, if any of you decided that you weren't going to pay your electricity bill, the process will go as follows. There will be a process which will get you to court. Most SMEs don't have that. That is what we can provide if a client needs it. Our clients fit into two categories. Those who need the cash against the invoice plus the service, and that's factoring. And those clients who just need the cash against the invoice, but no service, because they have all the aforementioned facilities to take a customer from letter before action to court to collections. They could do that themselves. And that's a confidential invoice discounting facility. Now, the latter is about 80% of the market. And the reason for that is that most customers are now a lot more sophisticated than they were 40 years ago. They've all got zero packages or similar. They've all got a credit controller or similar. They've all understand what the Dunning cycle is. But the very tiny SMEs don't, because of course they go and raise. Sorry?
Did you say Dunning?
The Dunning cycle is the chasing of a debt. So it's it's a regularity of chasing. So letter goes out in 7 days from due date, 14, 21, 28, letter before action, court. So that's referred to as a Dunning cycle. Okay. So most SMEs will not understand that. So
how big a team typically have to be to do discounting? You mentioned that's around 80% of the market.
Yeah, how big? That's a good question. I mean, it used to be a very hard and fast criteria 40 years ago, but things have changed because then there wasn't the sophistication of being able to get information on a real-time basis as you can now. So typically the average invoice discounting client in the marketplace, now bearing in mind the market for invoice discounting is the biggest deal that we ever did at my previous employer was £700 million. Wow. So it ranges from that to that. So the average is about 5 million in the industry. And the average is the business has been trading for 3 or more years. Solvent, makes profit, has a hierarchical structure. In other words, the MD does not do everything. There's a structure within the business. There's the MD, there's a minimum, there's an FD, and there's a credit control function under him or her. There's a ledgering clerk or a combination of the two. So there's a structure there to demonstrate that that business understands the goods go out from the warehouse and gets turned into cash through the process of credit control chasing that and bringing the cash in. So that's what an invoice discounting plan sits at.
But
So,
can it be very lean though? Does it have to, can it be a 2-3 man band? You have the manager.
it can be if they're fairly well organized. And I guess tech today makes even a very thin, flat management structure suitable to that process. It's the ability to produce an aged debtor report, which is important because our security is the debt. And the value of a debt, and this is what people really need to understand in the industry, not all invoices are valued the same. So if you have an invoice which is dated between 1 to 90 days, it has a higher value than the invoice that's dated 90 to 120 days. Because once it gets to beyond 90 days, the chances are there's a dispute, or the customer's in some financial difficulty. It could be a probable bad debt, or could be a dispute. So it's important for an invoice finance company and important for a client to understand that their debts need to be amortizing on a regular basis, needs to have that point that it's constantly turning. That's important. That's one thing.
Your debtor ledger, again, just to like debunk everything, is just the debts that are owed.
It's the debt. It's a debt that client raised. So an aged debtor report is your list of your customers that owe you money. And those customers are typically aged on an aged debtor report, 0 to 30 days, which is often referred to as current, 30 to 60, 60 to 90 is the next column. And there should be very little between 90 and 120. And 120 plus should be nothing in there, because this is another issue for a lot of SMEs. Is the reason why they often have cash flow difficulties. They do not collect the debt. So the goods go out, suppliers are paid, including preferential creditors, which includes HMRC and staff, and they don't collect the debt. And the reason they don't collect the debt is that they're terrified of a large customer. The customer may not place another order. They may be viewed by the customer in their eyes as being aggressive. Hence the reason why sometimes you get resistance to factoring. You may upset my largest customer. Well, that's a fallacy, really, because if a factoring company upsets your customer, there would not be a factoring industry. So that debunks that.
So and when you so I'm just thinking from small business owners and what they're not going to. So you've just set up you've got a business, you've been trading for 18 months, you've all of a sudden got debts that aren't being paid. They can come to you to try and release some cash flow to pay the invoices. But say I don't know, Jim's garage, I owe money. Well, so he owes me, I need to pay him, but I need an invoice, cash flow release on an invoice. Would it show as Muse, or would it show as my business name, or would it show?
That's a very good question. So essentially, we work on an assignment of debt basis. So we purchase the debts from you. So you raise the invoices in your company livery, your company registration number. So you raise the invoice. Invoice finance is making the sale of that asset to me. So I buy the invoice for the service fee, which is the charges we'll talk about later. So the invoice will still be noted as coming from you, Samantha, but at the bottom of the invoice, there will be what's called a notice of assignment, which states that the debt is owned by Muse Finance. And to discharge that debt, your garage must make a payment to Muse and not to you. So it's important that a business understands that one of the major security features we have is that your customer must no longer pay you, because there's a potential there that you can have 80 or 90% of my cash and retain the 100% that the customer has paid, and the debt has not been paid. So the customer so you as a supplier, your liability to Muse is paid by your customer. So it's an arm's length transaction. Hence why we will never fund a connection between two businesses. So if you had, say, 5 Samantha Limiteds and you're trading together, no invoice finance company would fund you, because it's just you. So all your customers have to be at arm's length to you. That's important. Do monitor that through our tech.
Yeah, I think that's something that a lot of businesses would be wary of, because they don't want to feel like somebody's almost chasing a debt for them, because then it almost feels like you're a debt collector. So, you know, for the invoice still to say my name would still continue those relationships. I also think it's really important for a business owner to trust the business that they're working with for the invoice finance, because essentially, you know, it's your reputation as well as a business owner on the line. So you need to make sure you're happy with the business you engage with, whether that's FundOnion as a brokerage who's going to go to a lender, or whether that's engaging with the lender themselves, which would be Muse.
Yeah, you make a valid point there, and the industry has worked extremely hard to make sure that there is nothing but transparency in it. Otherwise, people like FundOnion would not be working with invoice finance companies that don't exhibit those characteristics. So that's taken as a given. What we do know is that before COVID, the volume of invoice finance advances almost caught up to overdrafts, which we didn't think we'd see in our lifetimes. Obviously, with COVID, and given the fact the way in which our industry is based on sales, during COVID, there was no global sales. So, of course, we then went down because our funding is linked to invoices, right? Invoices to sales. The banks are all linked on retrospective security valuations. So it's stuck. So the bank ended up stuck with a whole load of stuff that they're still stuck with. And that's going to unravel soon. So if you look up to the west, the skies are black with the chickens coming home to roost. So we were quite lucky in that we went down because sales were down. So customers, getting back to the point, do see us as being honest and transparent. We give the good, the bad, the ugly, they understand what it is. In terms of clients who may think the end of the last resort, the important stat for you, 1 in 6 invoices are currently factored. So you will see it and it will become more and more. So it isn't something that people are not used to. And also you've got to think about where, like anything, we've all had bad experiences with products and services that we buy. But if we sit back and we look at it rationally and we point the finger, there's always 3 fingers pointing back. So a client will always say, I've had a really bad experience with factoring. And when you actually get to the nub of it and ask, well, what happened? Well, John always buys from me every single week. So I decided to raise an invoice and John decided not to buy. And the factor got angry. Well, the reason why the factor got angry, you fresh invoiced me. So you invoiced me on a debt that will never be. I lent you money on something that will never be paid. So that's why we get upset. That's a major no-no. And clients will try to do that. So a major thing that SMEs must understand is that we don't lend, we advance money on the premise that something has happened. So the debt, a bit of jargon now, is what we call contractually complete. So in other words, you go and you want your house clean. I come in with my team, I clean it, it's spotless, it's been done. I sign a satisfaction note with you, it's done. What I can't do is raise an invoice on the basis that I will do that, because I could get knocked over by a bus and not complete the transaction, therefore there's no payment to be made. So those are the fundamentals. It has to be on the debt that is verifiable. So
this is actually one important point that I think people might use with, it's the term invoice finance. With invoice finance, factoring, discounting, spot factoring, whatever it might be, it's that it's not an injection of new money into the business. You're just pulling your forward revenue to you earlier. And I think sometimes business owners can have a little bit of a confusion. They think, oh, I just factored 100 grand invoice, I just got 100 grand new money into the business. No, that's the revenue that you've already booked for whatever it is, the next 4 weeks, 6 weeks. And people need to bear that in mind, because you can't have your cash glut Monday the 1st of August or whatever it is, spend all that money, and then you realize that you haven't got anything left for the rest of the month. So it's
that's
not
a very
actually
good point.
It's just a forward advance, as you say, Peter. It's selling your invoice, getting paid earlier, but it's different to saying, oh yeah, I've got 100 grand loan or 100 grand equity investment. And I don't even know if, I mean, forgive me, I'm not an accountant, but I don't even know if you would categorize it as a debt, because invoice finance, your outstandings to the invoice finance provider can never be higher proportionate to your receivables.
Correct.
It's not new money. I think that's something that upsets people because they treat it like it's new cash in the business.
Yeah.
No, you make a good point, and Muse is trying to smash that by the tech, by having a predictability of your cash flow. Note the word cash flow in your 30, 60 and 90-day window, based on analyzing your bank account to give you what your cash requirements will be over that period of time. And again, it's just telling you that you've got revenue potential in 30 days that you can use to fund your cash need now. You've got revenue potential in 60 days that you can use to fund your cash requirements within that 60-day window, and so forth. Now, I will always remember that many, many years ago, accountants didn't know how to treat invoice finance in terms of when they struck the accounts, and they couldn't get into their head it's a non-amortizing facility. So now if you look at most sets of accounts, the debtor figure is left as it was, because what some accountants used to try and do is, so actually it's not there anymore. Yes, it is. Exactly what you said. All that revenue, if you work out the debt term in the balance sheet, and for argument say it's a 72-day debt turn. Debt turn is the time it takes your customers to pay their invoices.
Yeah.
You know that money's going to come in within 70 odd days. You know that. So the invoice finance facility brings that forward by 71 days. So you now see the notes to the account, which will say, by the way, whoever's reading this account, there's an outstanding liability to Muse of £176,000, which is owed to them as of this day. So anyone reading those accounts will take that off the debtors, or take that off the net worth. So you know there's that liability sitting in the balance sheet. So you know that, because that has to be paid. In the gone situation, our all assets debenture will guarantee that money comes to us first and not to the shareholders. Mm-hmm. So it's getting customers to understand, and that's what the job of the BDM is, to say that what we're funding is your day-to-day cash need. Yeah. Without the money, you will go bust, because HMRC will send someone from Cardiff to knock on your door for that payment. If you have a time to pay and they give it to you in good faith, and HMRC is not bad as people say, pretty good given what they do, they will give you a time to pay. And a lot of people breach that.
Yeah.
I think that's also a key point, because like the new money versus forward revenue advance point is like, with invoice finance, it's more of an ongoing relationship. These facilities, they can go on for years and years and years. Mm. But if I've got Peter Felix Wines Limited or James Robson Lager Co, whatever it is, deal, Mr. Bank, you give me 150 grand as a loan, I might just pay it off and I'll never speak to you again. Yeah. But if you've got an invoice finance facility, I think people need to understand that it goes on for a long time. You manage the relationship. It's not new money. It's something to help you manage your cash flow and keep people from trying to. I
think probably at this point, I can show a couple of examples of deals that we've done, which perhaps people tuning into this can actually see the power of an invoice finance facility. That, because at the minute when you're talking about something, it's like the nebulous cloud that Star Trek Enterprise always finds, right? It just goes on. It doesn't mean anything until people like something that's tangible, they can touch. So
well, I want to humanize something really quick, just to kind of go back on what we touched on, Peter, about a lot of people might not get invoice financing because they know they've had a bad experience or just don't understand it. Let's humanize it and go back to, a lot of SMEs are human beings like yourself, myself, James. You know, a lot of their businesses are their babies. Could it also be down to the fact that they're embarrassed? They don't understand that. They feel that, you know, if we go to their, if you go to their suppliers that, you know, manufacture, they're like, oh, this is embarrassing. This must mean that I can't afford it. I don't have money. I believe that a lot of the SMEs that are listening now is, don't be embarrassed. It's purely business. It's nothing personal. A lot of your suppliers and manufacturers that you're going to probably have been in this situation before. They might even have some sort of factoring discounting facility themselves. So just to make it clear, it's not an embarrassing thing. It doesn't mean that someone's going to think you can't afford something.
No, you made a very good point. And when you go back historically, I can't use the name of the company because I no longer work for that company. But one of the main players on the Dragon's Den started the business, which he started out of a cupboard in Knightsbridge, just for the address. And that individual started factoring with my previous employer about 30 odd years ago. And his business, and still is, a large staff agency, one of the largest in the UK. And many a time he'd attended our sales conferences and basically pointed out that without this company, I would not be where I am today.
Absolutely.
Because he had thousands of office. This is one of the original volume providers of staff. Now he operates as a facilities management company where he's powerful enough to go to the NHS and say, do not deal with all these hundreds of agencies, deal with me and I'll deal with hundreds of agencies for you. So that's how powerful he's become because of Invoice Finance. And because there is no way that you can go to a bank and say, really sorry, I've got 5,000 employees to pay this week. The bank will let that go. Next week, you go, there's 7,500. Where did they come from? Next week, 11,500. Where did they come from? I'm a staff agency, I'm taking people on. Invoice Finance grew with it. And that's a fixed situation. And a lot of people will take the view of, well, it says I haven't got any cash. But I can tell you this now, to get an invoice finance facility does mean you have to go through a robust financial check, a robust DD. If you pass that DD, it says that you are creditworthy. Because you think about what an invoice finance company does, it gives you up to 90% of an electronic transaction that says invoice. And we're trusting the fact that you've raised that invoice. There's certain people who will never get invoice finance as long as they live because they've breached the facility elsewhere, they've got a poor credit rating. But for businesses where you see that notice of assignment stamp, what that tells you is that somebody else is putting their money into that business because they can see that that business is sustainable. Because if that business is likely to fail, because an invoice finance company, the worst nightmare for us is a client bust. Because what happens is that all the customers will dispute the debt. They don't want to pay it. So we have to be very careful to make sure the clients that we take on have longevity, because we get paid by the debtor. The debtor will only pay if they've had the service. And that's the situation.
I think, you know, Jay, you've both made a really valid point. And I think what people need to realize as business owners is, you know, if they take on a business loan to pay suppliers, they are causing themselves another debt. Whereas this is a way of keeping your company fluid and moving. And like you just really pointed out, James, it's not new money. So it's not money that you're going to owe again. You know, it's money paying for itself almost, because it's business that's been done. You know you're going to get paid and somebody's just releasing that little bit of cash flow for you. And personally, as a business owner, I would rather work that way than go and take out a loan for £50,000, then I've got to suddenly pay that back.
But look at it this way, in terms of taking out a large loan, and I think a lot of people are going to find that when they try to refinance their C-bills, they have to refinance those on commercial terms because the banks are no longer going to operate as the charities the government forced them to become during the coronavirus crisis. So if you have a loan, you've got that liability, the bank has got the personal guarantee. Now, there's a massive elephant in the UK corporate room now, and that is the Crown right of set off in terms of the HMRC now being a preferential creditor. So if you're sitting as a banker and you've lent Joe Bloggs X, and suddenly for your monthly monitoring, you can see he's got HMRC liability, it's going to move from your control as a friendly manager into LQE, which is low quality exposure. The low quality exposure managers are not your friends. Their job is to protect the bank and its shareholders. And that's when you lose control. So that's exactly what Sam says. You may lose 1 or 2% of your gross margin. So what? You keep control of your business. And you're avoiding taking a liability on over which you have no control. And that's the situation.
At the same time, I would say there is I mean, obviously, as a whole of market commercial finance broker, we do We like Invoice Finance very much, factor in your discounting, stock finance as well. We're currently working on a beverage deal currently. We do a lot of straight up business loans and asset finance. There are so many different permutations of businesses, and there are so many different permutations of financial products that I think in the case of something like growth, you can't really finance growth with an invoice finance facility because you need that new money. And take, for instance, you might have Couture shoes, Neil's
Great
shoes.
business, by the way.
You might look.
Is that your business?
Not yet, but it might be.
You might look to make 5 or 6 different hires, and you want to hire them through a recruitment agency. You need to pay up front on the recruitment fees of the salary for those individuals. Those individuals in 3-4 months, you forecast are going to be churning loads of revenue, maybe they're salespeople or whatnot, whatever they are. But in that case, that is when you might want to look at a injection of new capital.
Yeah.
So I guess my point is that everything is different, and I think all business owners should keep an open mind.
Yeah.
Financial services and money, it's not money in the sense of, back to our original point, it's not money in the sense of profit or your personal cash. It's an input, it's a supply that you put in your business, exactly the same as stock, people, infrastructure, office. But you've got to make sure you get the right one that fits your needs.
Yeah.
And I think it's great that there are so many different providers out there.
No, you're right. It's a graduation of funds. I think if you look at it from a football viewpoint, and you look at what's the Premier League will be where you have got equity sitting in that space, which is very expensive money, but it'll allow a business to scale up. And you go right down to Mayor's structured, then you come down to where we are at that point, and you probably put loans slightly above ourselves, but that's where you guys come in, like the financial gurus that you are, in that you have to have a whole market approach. Whereas for me, being in corporate finance, I just need to know a certain bit detail wise, but know a little bit about everything. And you guys know everything about everything. You have to, because your clients' characteristics are so different in terms of what you want, and your job and your skill set is to listen to what your clients say and say, this is where I think you ought to be based on my experience, right?
Yeah, but it's also very important also to make sure we also listen to what you guys say. Without you guys, we can't find our clients. So it's good to always be keeping up to date with yourselves, Toby, making sure that we're fully aware of your products. If your advance rates changed, like you said, things are always changing. It's kind of a ridiculously quick environment and market. We have to make sure we're making sure we're matching the right lenders to the clients as well. And like James said, there are so many invoice finance providers these days, more than I would say asset finance and normal business loans. So
150.
There you go.
And I do think that,
sorry, Ash Burgess coming through again.
without getting too topical, like on a current point as well, like obviously the equities markets on the one side have been hammered this year.
Yes.
Not seeing quite a big change in terms of like bonds and fixed income instruments with money flowing there, like on the high end. And then obviously it disseminates down to people, lenders that say, you might have your big investment banks that fund other lenders that say, we want a book of SMBs or SMEs in whichever jurisdiction to hedge against this. But at the same time, we're seeing clients right now that, they are feeling the pinch, they do need support, and they need to find the right product for them. So I think going forward, for the next period of time, I think it'll be an interesting,
I think the next 18 months is going to be quite interesting because if you look at businesses, everything's on their liability side of their balance sheet at the moment. That's where it sits. And obviously, at some point, someone's going to want to make some profit at some point, and someone's going to want some flexibility at some point. And you find that more businesses will go bust when the recession comes, but more businesses will go bust as we come out of recession because they'll overtrade. So unless they have conversations very early on, and sometimes I get the impression that some of the accountants are just sign off the annual accounts every year and do nothing else. And if we can see it in this forum that there's going to be this U-shaped thing coming in, very few, unless you go with the big boys, the top 5 advisory services, or that's probably unfair, the top 20 maybe who have advisory services, I guarantee that those guys who have very small accountants are not having this conversation.
It's a great point.
Well, it's expensive to get that kind of advice as well. And a lot of time. So you've got to kind of fit a special kind of profile. But at the end of the day, I mean, that's why I think having, good out there like aggregated services or services with like a technology-driven approach.
Yeah.
It's important now to be able to write a deal or write a quote relatively quickly, rather than taking 2-3 months. We'll come back to you.
Yeah.
Like
the long no, as it's called in banks, the very long no.
Do you want to just share those slides with us, Peter?
Yeah, absolutely. Absolutely.
What type of clients can get?
I think a lot of people recognise their own business, but these are just a few deals that I did. So we had a clothing supplier that supplied a lot of products I never heard of, but they were very well known in the marketplace. But the problem is, obviously, not being in that age group, never heard of them. But their existing facilities with the banks are well supported, as you can see. Overdraft of just under $500,000. They picked up a relatively small C-bills of 700. They obviously ran out of cash at some point and picked up a funding circle loan of 100 grand. And HMRC arrears started to build up again. So the company, obviously, during COVID, did very little. But as soon as COVID ended, everyone started coming out. You just have to look at London today, everyone's out. They picked up an order, 4 million from a good debtor.
Wow.
The bank, being a retrospective lender, and you can't blame banks for being that way, there's no security on offer here, couldn't extend the overdraft. Now, they referred it to their Invoice Finance company that said no. Now, it took 8 weeks for that company to say no, but what we don't know is whether or not this client was providing all the information the bank needed, that's important, or whether the bank influenced the Invoice Finance company that not to take or extend the liability further to this company because they wanted out. That we don't know. So that's a conversation, I guess, we will never be party to. So our solution is fairly simple. The company had debtors just under 2 million. Projected debtors with the Primark order is going to be about 2.5 mil. So we provided a 3 million factoring line with bad debt protection. That's the only way we can do that because they had a near enough 100% concentration. So concentration, for those people listening, is where you have all your eggs in one basket.
Okay.
That is not a good place to be. And I know there's lots of SMEs who will say to me, my only customer is Marks and Spencer's. I've been dealing with Marks and Spencer's for 30 years. No, you haven't. You've been dealing with an individual within that organization for 30 years. That individual leaves, or a new buyer comes in, they may bring in their other suppliers and you're out. So that's why concentration is scary for us.
Okay.
So on day one, we just put in just under 1.4 mil. I rounded it up. And obviously the overdraft was cleared. HMRC was brought up to date. And the business ended up with just under £630,000 to go and do with what it pleased. Now, for that, the business has paid us 74 grand.
Okay.
Now, think about where they were.
And
for £74,000, they've now got free cash. They can trade. The directors are now in a position where the business will trade through successfully. Compared to where it come to. It's very much like, imagine one of our Formula One drivers racing around Le Mans, and yesterday there wasn't a brick wall. Without him knowing, we built a brick wall, which is what this was here. And he's going to crash. And Muse has come in and said, we'll build a tunnel. And here you go through that. And that's what
I like that analogy. That's very easy to understand.
And that's what Invoice Finance does. It's simple, and it's all based around the honesty of the client. And it's based around about the transparency of the trade. That's important.
And what if a client comes to you for Invoice Finance? What are the initial tick boxes almost that you would ask them? It's fairly
simple for us. Do you sell on credit terms? Yes or no. Do you have an outstanding debtor book? Yes. Do you have a proof of delivery to prove what you've done? Simple as that.
Would it be the same for you guys?
Sorry.
Would it be the same for you guys at FundOnion? Would you ask the same questions?
Just free.
I think what Sam asked is what's a quick and dirty to the client to make sure that they're going to.
I think I was adding that they need to be business to business. I take it on the sales, not business to consumer.
Yeah, and on our platform, we had a standard user journey where it asks you kind of what you're looking for. We've now designed and kind of created a kind of a. I'm going to be saying this is exclusive. It's exclusive for the user and director's choice. We've designed it the invoice finance journey. So there's questions that, or tick boxes that, Peter just confirmed exactly what we have on that journey. So yeah, everything you mentioned, plus what James said is exactly what you need to hear. And I guess find out, good year actually. Good year, perfect.
Absolutely. Get started,
Right. I mean, is there anything else that you guys want to go over that you think business owners, SME owners that would find relevant with invoice finance?
Well, I think the last bit, the other examples, there's no need to go through it. Just basically this one, I think, says it all. But a lot of people often will say to me, I attend quite a lot of business functions. Because my role, the role of Toby and my other BDM is that we're educators. So we spend a lot of our time educating people. I think when we started this conversation at the top end of it, it's talking about how many people don't understand it. And how it's filled with misconception. And one of the things that people don't quite understand is how is all of this secured? And you'll see that?
No, I have made you host.
Okay.
You just need to share.
Hang on. Not sure what I'm doing there. Right, let's go back. You made me host. Okay.
Yeah.
Share screen. There we go. Apologies. So you didn't see the, there you go. Right.
Perfect.
So essentially, this was the example of the deal I spoke about in terms of what we did and everything else, how that worked. And in order to secure all of that, this is how we, generally speaking, packages the facility. So for us, our primary security is the invoice, in that the invoice relates to a B2B sale that is contractually complete and is provable. So we can prove that transaction took place. Now, you've always got to lock the people in because it's people. Within the banking fraternity, we used to have what's called the three-legged stool. People, financials, security. The people bit was what lost you money. And that's where the bank had spent years teaching us. Before we were allowed to see a customer at the bank, you were trained for 6 months before you were allowed out. And a lot of that was through a company called LDL, which is learning to psychologically profile customers to try and avoid the ones that are going to take you. However, personal guarantees are required, and that's normally 25% of the facility. So that gives us confidence that the individuals are committed to that business. They're committed because we're putting in substantially more than they are, and they're getting out substantially more than we are. So they need to guarantee that things are going to be exactly what they say.
And what can you use as a personal guarantee?
Well, personal guarantee is you signing a document. We do not take any external security such as charges on property. So in the end, if a guarantee is called upon, an individual may have to find the cash from somewhere to repay it. And normally that is done through some form of installment payment. But we do not say to people, don't worry about it, it's just a document. You are making a financial commitment to a lender that in the event of anything going wrong, you are standing in. For most people, the guarantee means that they are acting as our agent to collect the debt because they are in that coalface. They're the ones the customer knows, and the customer is less likely to renege on the debt if it's Samantha because you're their friend. They know you. To a big organization, they'll assume that we're a multi-million-pound organization. We can take the hit. That's what people assume. Hence why people have no qualms about seeing a supermarket take a loss. They have no qualms about it, but an individual, they do. So we try to keep that person locked in. Some companies will have a sort of umbrella structure. So in which case they may have various trading entities owned by the same director. So we want an associate company guarantee, because companies will, for the right reasons, move cash around their spider web, which is fine. It's when they do it for the wrong reasons. So we need to be able to make sure that our money is always going to be repaid. Okay. The debt has been sold to us. It's our property. It belongs to us. So it's no different to a brick and mortar sale. That asset belongs to us. And we register our ownership via what's referred to as an all assets debenture. So it means that that security cannot be sold or pledged elsewhere. Now, in about 99.99% of cases, there's already an all assets debenture registered by another lender. And that lender is often in agreement with us that Muse is better placed to fund the working capital, leaving them to fund the other assets. So we'll enter into a deed of priority with them, which will stipulate that Muse has first call over debt, second over stock, maybe if they're funding that, second over plant machinery, second over buildings, whatever it's going to be, but we rank supreme on debt and they rank supreme on everything else. Where there's just a single debtor, often the bank, we will just have a waiver from the bank, which the bank waives its rights. But normally it's the way invoice finance companies have to be very, very clever to read the bank's waiver document. And that is, the bank will waive their rights to the debts for a stipulated period of time. What some banks will try to do is put 24 hours. That's impossible. Impossible. So we always read the document. And most banks will normally give us 3 weeks.
Okay.
Which is reasonable. Because by the time you get everything in play to get your money back, 24 hours doesn't just cut it.
Yeah.
So those are the security documents that every business that borrows money will be used to. And we talk about this upfront whilst the negotiations going to the client gets the initial offer with all the security requirements in it, the confirmed credit-backed offer. Again, nothing has changed. If there's any changes between the first meeting that we do and the final offer coming out, the bit in the middle would have been discussed with the client.
Okay, so you're totally transparent, which is really good, and you explain from the beginning what expectations are, so everybody understands what they're entering into.
Correct. We wouldn't do a deal under those circumstances, and the first thing we tend to do with a client that's on board is that our client services department will phone up to check the journey's been okay, clients are happy, and that's important to us, because obviously we're not a bank with a 3 million numbers of SME as NatWest has got. We haven't got that. So most of our 99% of our business will come from introducers, and a significant and increasing proportion of our business comes from client referrals who've come on board with us, having left their traditional funder and like the way in which we do things, and will bring their friends with them. So they wouldn't do that if we weren't transparent in what we do. Yeah.
And that just really leads nicely, Peter, onto how we work as a platform and how we want to introduce people to both FundOnion and Muse. Director's Choice is a platform to help grow and support businesses, and we do this being totally transparent. We're partnered with companies like yourselves because you're credible and you're transparent. And what we want to do is to help educate business owners, which is the reason that we're doing this, on how they can grow their businesses. And Invoice Finance is a way of them releasing some funds, which then allows them to concentrate on the growth of their business. As James explained, it's not always to be used for business growth. That might be a business loan that you need, but it's a way of making your business sustainable and to keep going and to then move forward with your growth strategy. And having you both as partners, is exactly what we want, because both of you have the business owner's best interests at heart. And that is something that's really important to us at the Director's Choice. And also really important that you want to take part in audience with webinars like this, because this is all about helping business owners. And that's exactly what you guys have all just done. So I'd like to thank you all for your time. If you do have any questions for Muse or for FundOnion. You know, you can reach out on social media to them. You can reach out through the platform. You know, if you come to our platform, there's lots of education pieces. And once you've read the education pieces, then go on to the comparison part and, you know, engage with these two brokers and lenders. So thank you so much for your time. If everybody's done and you've got nothing else to say, I think we can wrap it up.
Thank you.
It's been an absolute pleasure.
It's been amazing. Thank you guys. Appreciate it.
Thank you so much.
Thank you.
Thank you. Thanks
Cheers,
very
bye.
much. Bye.
Bye now. Bye.